Hello, everyone, and welcome to The Upside. I'm Kyle Cheropita, joining you today from Fidelity's Montreal office. So on this show, we'll be looking at August market highlights and top stories by counting down the top 5 highlight clips from our FidelityConnects webcast. Connects is first live for financial professionals and then released as a replay for all as a video podcast, with new episodes dropping daily. First off, clip number 5 today. Have U.S. markets shown signs of peaking? If so, international markets may offer a compelling alternative. Patrice Quirion, portfolio manager of Fidelity Global Concentrated Equity Fund, International Concentrated Equity Fund, and Global Fund, joined Connects mid-month and shared the benefits of diversification while highlighting key opportunities in Europe, China, and emerging markets. For those joining us from Quebec, we also have a French webcast with Patrice streamed on the same day, so check out Fidelity Canada's Dialogue Fidelity podcast for that video.
You've been doing nothing but being ahead of a lot of international trades over the course of the last little while. It's been nothing but international for the first 6 months of this year. Is that it?
I don't think so. Those trends, I like to bring everything into a framework where most patterns will follow some sort of cycle. There are short cycles and there are long cycles. The short ones, everyone's paying attention to. The long ones are easy to get overlooked or to get confused with like a secular trend as opposed to a cycle. And what I've been talking about for like over a year now, well over a year, is that I think we are getting to this point where the US economy, its consumer, its fiscal spending, its corporate spending, is starting to look somewhere close to the peak of its cycle. Those long cycles last a long time. As a result, it's hard to have the perfect timing on exactly when that changes. But I think this is the picture. But what's interesting is you look elsewhere, you look in Europe, and especially you look in China, and you can start looking at same like main economic players, the consumer, the fiscal side, the government, and the enterprise or the corporate sector are all closer to a bottom or maybe a little bit more like mid-cycle in Europe. And those eventually revert. And you need a catalyst for it to revert. It's really hard to tell when the catalyst happens or had happened. But I think if you try to invest with a longer term horizon, which I do, I try to bring it back to that framework. Because those cycles, they don't last like the first 6 months of this year. They last for like a decade. And we've had a lot of those over time. Like it was oil in the 80s, Japan in the 90s, like the internet bubble in the 2000s, and you had China and commodities, and now we just had the US. So is it turning, or as it turned like November 2024? I can't guarantee you that. It's really hard to guarantee anything. But you look at how the markets are behaving, and it feels like we have basically turned a corner back then. I think you're seeing it from a different viewpoints. Like the performance of China and Europe was really good, Q4 last year, Q1 this year. And then we had Liberation Day in early April. And after that, the market took off. And it was led by the NASDAQ. But if you skim through the market in the US, like the S&P 500 has done well, but it is so narrow, once again, especially in the US market, where if you take like a broader representation of the US economy, take like the S&P 500 equal weighted, or take the Russell 2000, and those like broader indicators, in my opinion, than the NASDAQ or the S&P 500, is still lagging even on that like US recovery post-tariff is still lagging the rest of the world. And pretty much everything, it's lagging China, it's lagging Europe, it's lagging Japan. And I think and I feel a lot of people are not really paying much attention to that or not talking a lot about that. But the fact that you just had like this massive relief rally that I think is potentially more than just that. I think there's a lot of momentum, fear of missing out.
You're talking about in the US specifically.
On that rebound in general, but
Okay.
It's much more acute in the large cap tech trade, which is mostly in the US. But yeah, despite that, like the trend underneath the surface, I think is still intact or continuing, if we can put it this way. So to answer your question, I think there is more to go on this. Will it be of the magnitude of what we've seen in Q4 and Q1? Very unlikely. Like when you hit those inflection points, assuming this is one, those inflection points like convergence are very abrupt. They happen quickly, large magnitude, but usually they last. And what gives me the confidence that it can last is back to that sort of cycle framework. We are still there. Okay, maybe the market's a little bit more optimistic about Europe rebounding from like German like fiscal spending picking up. But this is not the big story. The big story is if we were to, and like follow cycle, we will. The question is when, is it now? But if you get like a broad reacceleration of those economies, like in most of the rest of the world, which are kind of like scraping the bottom, it's going to be much more than one sector. It's going to be broad. Like you'll get consumer confidence coming back. You'll get like supportive fiscal spending. You'll get corporate spending following that. And it will last a long time.
Up next, number 4. Early in the month, we focused on AI, cybersecurity, and the changing tech landscape with John Bradley, Director of Emerging Technologies, and Vishal Chopra, Equity Research Analyst. John and Vishal shared their insights on the intersection of technology and finance. Take a look.
Let's talk about ethics. Sure. Let's talk about globally what's happening from an AI standpoint. A lot of economies are saying we've got to have some rules in place. Mm-hmm. What's your take on that?
I think it's the right approach. I think with any tool that is new and can be misunderstood, we want to make sure that we're being risk averse when implementing it, especially when it can have important impacts about people's financial futures or other important life events. So I think ethics should really be at the forefront of implementing these types of tools, as well as consideration when creating regulations to monitor and manage them. We want to maximize the value while minimizing the risk, and having ethics be at the forefront of the conversation, I think, is important.
Very interesting. Vishal, you are focused on Canadian companies, but it's a global marketplace, and you have a team that you can work with that is global. You have access to visiting companies wherever you need to go. You also go to conferences wherever they are, so you can see, and it's extremely efficient for you because you can see lots and lots of companies in a matter of days. Talk about that research ability that you have, and then also, what are you finding from an earnings standpoint right now?
Yeah, I think in terms of the research opportunity, you have the ability to basically not only go to any conference, but also we host bus tours. So last time I was here, I was in California. We got to see a lot of different technology companies, some of the largest companies in the world as well. We got to ask them about their views of AI. Anything that was coming up in terms of a debate on the stock, we could also ask these various companies. And over a span of a few days, think about like, okay, which company sounded like good, which company sounded bad, like which way are we leaning on certain debates after talking with all these different companies. And it's both on the public side as well as on the private side. From an earnings standpoint, I think you're continuing to see some of the trends hold where AI sounds great and likely continues to sound great if you pay attention to some of the companies that are spending on it. And we'll see from software. It's been a few rough years where people, I think, maybe potentially over-modernized during the pandemic and implemented too many SaaS tools and software tools. Maybe we're looking at some of the software tools and being like, do we still need this? We don't really use it. You're seeing a bit more digestion in that space, but I think overall it's still very optimistic about technology, and people seem optimistic that they're going to continue to adopt it at an accelerating pace.
I get flashbacks to the late 90s. I know you don't as far as all of this, of the tech bubble. And there was a lot going on and there wasn't much supporting it. And then that was realized in the market. Would you say though that today there's a lot going on, there's a lot of utilization as you both have talked about, and so there is support for what we're seeing?
Yes, I think not to the extent that of the magnitude of CapEx today, but you are seeing significant growth not only in AI native companies today, but you're also seeing some of the largest companies in the world report significant growth in their cloud operations. And I think you are seeing productivity improvements. If you talk to tech companies, everyone is talking about how AI is impacting software engineering, how it's impacting developer productivity. That's a bit harder to quantify what the impact is, but it is positive in terms of the ROI that companies are seeing on the investment today.
John, let's go back to cybersecurity.
Sure.
Deep fakes.
Yep.
We're seeing things on different mediums
Yep.
of people who really aren't themselves or saying certain things,
Right.
telling people to buy certain stocks and so on.
Yep.
What should investors and advisors do to protect themselves from this at this stage?
I think it's really, it's a good question. I think it's really important to exercise caution when you're looking at any type of communication you're receiving. And if something feels a little bit off, you want to make sure that you verify in a different channel or a different way that communication is authentic. Because these deepfakes, as you mentioned, are getting better and better. Now it only takes a few seconds or a few minutes of audio or video, and you can come close to replicating somebody in a digital version. And so the easier it becomes to create these fakes, the more we are exposed to potential risks. So you have to exercise caution.
I'm sure a lot of our viewers and listeners today get these calls every day from different locations in Canada and the US or wherever that are unknown, which I don't answer. But my understanding is if you do, there is a risk that you're creating a voice print. If you're talking, is that true? Is that something that's valid?
It's potentially valid. So not all of those are going to be necessarily somebody stealing your voice, but the potential is there. And as I mentioned, I've been able to create a clone of my own voice using less than 30 seconds of audio. So if you're picking up the phone and you don't recognize the person talking to you, it's better to just hang up and not say anything than potentially expose yourself to that risk.
Well, that's great advice,
Yeah.
and there's a lot of that going on.
Yeah.
And it used to be so easy to spot these things, especially if you got a text or an email. There were spelling mistakes, the
Right.
logo was really
Right.
obscure.
Yeah.
Now they're very, very good.
Yeah.
What do you hear from that standpoint as an equity research guy as far as companies that are trying to protect us from all of this?
I think you're seeing cyber companies call it out as an increasing threat, both on the spoofing email side, spoofing voices, but you need some way to be able to detect it, and we haven't found a way that is necessarily foolproof for detecting it. So you continue to see very strong demand for cybersecurity companies, and just in general, strong demand for cybersecurity solutions. It's been secular growth for the last, who knows how long. And, generative AI might be the next driver for growth for a lot of these businesses.
Clip number 3. Denise Chisholm is a student of history who uses historical probability analysis when looking at the markets in her role as Director of Quantitative Market Strategy. Denise frequently joins both Connects and The Upside to share her insights on which sectors, trends, and underlying indicators you should pay attention to while evaluating the strength of the market. In this clip, she shares how she looks at the VIX volatility indicator. Take a look.
The VIX is something that you've talked about as far as often people would think, well, that's a volatility index. If it spikes, all bets are off. You actually see that quite differently. Could you talk about that, please?
Yeah, it's very much the opposite. I mean, you can see the patterns in the data. The higher the VIX is, meaning that the more fear there is in the equity market, the more likely the equity market is to be higher over the next 12 months. You can consider it a panic index, which is not to say that there's ever good news that happens right after the VIX is, let's call it top quartile position, say above 35. It doesn't usually mean that you get good news and that turns the market. It just usually means that the market has fully priced in most of the bad news that is out there. Said differently, there's nobody left to sell, which is not to say that there's not any individual left to sell, but for the most part, the sellers have likely already sold. So the next move is usually an incremental positive, which leads to incremental buying. Now, the interesting thing about the VIX is it's an asymmetrical signal. So what I just told you is a high VIX tells you that there's fear in the equity market. That's usually a contrarian good signal. So Denise, does a low VIX mean complacency, and does that mean it's a sell signal? No, in fact, it doesn't. Ironically, you get this weird U-shaped pattern in terms of the VIX, meaning when the VIX is complacent, let's call it, bottom quartile positioning. I think that's, let's call it under 18. When it's under 18, that's actually the underpinning of a secular bull market, meaning that you usually have complacency at the point at which the market is going higher. So that's often a good situation, and a high VIX is a good situation. It's usually in that muddy middle where the VIX is in a certain range and going higher, that where you actually see the problems associated with the market. Now, the interesting part about what I would call our leg of the secular bull market is we keep gyrating between very high VIX conditions, a whole lot of fear, and boom, right back down to complacency. So statistically, you're bouncing in between the two best setups statistically for the market. A whole lot of fear that gets resolved quickly. It is usually a good complacency environment for an underpinning of a secular bull market, which I do think continues.
Clip number 2 today features Connor McGrath, Equity Research Associate here at Fidelity Canada, and focusing on the evolving trends, challenges, and market dynamics in the insurance and real estate sectors. Among other topics, Connor spoke to how insurance companies are adapting to increased frequency and severity of natural catastrophes, and how these changes are affecting the real estate market, particularly in Canada and the US.
We get access to various forms of alternative data. It's hurricane season right now, so I use satellite data to track storms that are forming in the Pacific and Atlantic, try to understand their course trajectory, the strength of the storm, and you can analyze certain things around like wind shears and moisture levels in the atmosphere, ocean temperatures, things like that. And I think, again, it really speaks to the strength of the research platform that we have, that I have access to this, and I'm able to kind of help our portfolio managers make very informed decisions around some of the companies that we invest in, based on a lot of this work and a lot of this data that I have access to.
It must be fascinating for you to have a keen eye on what's happening with the tumultuous weather, et cetera. And when you were in university, you probably never thought you'd be monitoring weather. But it's impactful to what it is that you do.
Yeah.
You mentioned the conference for reinsurers that you went to visit all of them, typically domiciled in Bermuda.
Yeah.
How do they factor into this? Maybe a reminder for me and for our viewers, how does a reinsurer work? And are they potentially cutting off insurers who are then cutting off the consumer?
Yeah, it's a great question. So like to put it very simply, reinsurers exist as insurance for insurance companies. They are essentially a way for insurance companies to protect against tail risks. So think very large events, a 1 in 100-year event, a 1 in 1,000-year event, where an insurance company at the end of the day is very focused on protecting the capital on its balance sheet. That's paramount. And there's different ways to do that, but one of the easiest ways to do that is purchasing reinsurance and kind of additional coverage, where, you know, if a loss comes in and it exceeds a certain threshold, then the reinsurer takes a piece of that. And as you mentioned, yes, reinsurers do play a very important role in the whole value chain of offering insurance to an end consumer like yourself, let's say, because at the end of the day, if I'm an insurance company, I can't get access to some of that tail risk protection, then I'm gonna maybe reduce my risk appetite and write less business, let's say maybe in a higher risk market like California. And that has a trickle down effect on the end consumer, because then they have less available options to purchase insurance at the end of the day. And so there really is an end-to-end impact that you see that flows through the whole value chain, especially when some of these large events like the LA fires or hurricanes do happen. And you may not think about, you know, the trickle-down effects through the value chain, but they are very real. And from my perspective, I can see the full end-to-end impact of that play out.
Comment I have with auto insurance, and I'm going to relate it to home insurance.
Sure.
I think people sometimes think the auto insurance is based on what I've paid for a car. I bought a Honda Civic, it shouldn't be much. And then they get the bill, and it's huge because of the probability of problems, because there's so many that are out on the road. Is that happening with houses more so?
Yes, and it's interesting you bring that up, because when I talked to some of the insurance companies I covered, they gave some really interesting examples of ways that they use AI, ways that they use machine learning, and all the different data points that they get to, as you mentioned, become a lot more segmented in how they ascribe a certain amount of risk to maybe your house and maybe the one right down the street. And they may factor in things like the slope of the road that you live on, the grade, soil quality. They may also look at past events in your claims history versus their claims history. They may look at past precipitation levels in that certain part of the city that you may live in. And they all factor that into, hey, you know, Glenn may have to pay a slightly higher premium than someone a few doors down, mainly just because of factors X, Y, Z that we're able to put into our model, and it spits out a bit of a higher risk profile, let's say, for your home versus someone else's.
That makes sense.
And they can adjust pricing, and they can adjust the way that they segment that based on those factors. And it is really interesting. And again, technologies like AI and whatnot do enhance their ability to make those kinds of decisions. And at the end of the day, they're trying to get the best outcome for you, obviously, but they also are trying to get the best outcome for shareholders like ourselves if we invest in them as well.
Let's move to real estate. Sure. And perhaps we'll talk about residential purchasers versus commercial first.
Sure.
Interest rates. Where's the buyer at these days?
It's funny, because it's, you know, you would think with, you know, the amount of interest rate cuts we've had from the Bank of Canada so far that you'd see some kind of rebound or a bit of recovery momentum. We haven't quite seen that, it feels like. And a lot of my companies, I cover apartment landlords for reference, and so there is some direct competition with them versus the condo market in Canada. And that's a market that has been in quite a tough situation for the last few years, right? You had a lot of condo supply being built during COVID. We exited COVID, interest rates went up, and so right as a lot of these condos were being delivered and finished, you have a very high interest rate backdrop and not quite a very robust demand backdrop for buying these apartments or these condos. And so what you're seeing is a lot of these condos are now coming into the rental market. The owners need some form of cash flow. They're willing to just rent them out, maybe at a discounted price versus a traditional apartment. And that's creating oversupply issues within the broader rental market. And I think to a much more tougher degree than what we've seen in past cycles, unfortunately. And so the data I track does show that apartment rents across most major Canadian cities peaked in about fall of 2023, and they've continued to come down year over year since then. And a lot of that has been due to some of these oversupply dynamics that we've been seeing both in the condo market, but then there also has been some in the traditional rental market as well.
Our final clip today features Fidelity's Director of ETF and Alternative Strategy, Etienne Jonca-Bouchard, from his new podcast, The Upside Ticker Talk. On August episode, which can be found on YouTube, Spotify, and Apple Podcasts, Etienne is joined by Director of ETFs, Andre Bruno, for a discussion about the growth and popularity of ETFs among Canadian investors, how active ETF listings are outpacing passive, whether precious metals or Bitcoin ETFs are worth adding to a core portfolio, and so much more. Enjoy.
First question we have is and I'll ask you right ahead, and then maybe I'll add my 2 cents after, but if you could choose only 2 ETFs, what would they be and why?
2 ETFs to purchase in this market right now?
Yeah, it's just like, or if you're starting as an investor and you're thinking, what 2 ETFs should I start with? Let's do it. Let's tilt it that way.
Yeah, I think if you're looking to get into investing, and I think the first idea that comes to my mind is you want to build kind of a core portfolio. So to get your feet wet. So when I think core portfolio holdings, and obviously it depends on, your investment horizon.
Yes. There's asterisks everywhere here.
Let's assume you're, a younger investor looking to get into markets. Like where my head initially goes is you want something with broad equity market exposure. You don't want to make any, tactical bets right off the hop. You kind of want to dip your feet in. So there's, obviously if you take a look at historical returns, and as we all know, historical returns are not necessarily indicative of future results. But, U.S. equity markets have done exceptionally well and have outpaced Europe and other jurisdictions. So for me, one of the first stops I would do is look at core broad equity market exposures, particularly to the U.S.
Yep.
So that's the first place I like. Do you want to look for specific examples? Or?
No need for tickers, no need for names.
Yeah, so
kind of just more like investment thesis idea that can be done through ETFs, obviously, and that's a great example, right? There's a number of core U.S. equity,
and that's
ETFs.
The first thing I would look at, and the second thing I would look at, particularly if you have a long investment horizon, a little bit more risk tolerance as well, is looking for growth equities. Like if we're looking to compound over time. I like the idea, and that could be global or U.S. If you want to diversify a little bit, maybe look at global growth, which will have some U.S., some Canada, some international in there. Yeah. That is the second piece I would look for. Again, if someone who's looking to start out longer time horizon investment, higher risk tolerance, those are the 2 building blocks I would use to shape my initial portfolio.
Yeah, it's a great answer, and like you said, it's dependent on whoever the investor is. Various investor profiles, and that sometimes is with where you are in your career or age group, if you will, just demographic, I should say, maybe is a better way to put it. Sometimes it's just risk tolerance. Like doesn't necessarily mean what age you are or how much assets you have. It's just some people are more risk averse than others. But I'm with you. I'm kind of the same as usually you want at least some core equity allocation. I'd kind of cheat on this one. Also say that I think the multi-asset category is really interesting, right? So you can buy. There's a number of ETF portfolios. Obviously, we have some here at Fidelity, like our all-in-one ETFs. That's a great example. But something it's basically going to rebalance for you. It's got this, mechanism to rebalance from a geographic standpoint, from a style standpoint. Like that's getting as core as you can. But maybe that's an easy way out.
No, I think it's a good point though, right? Because you get that core portfolio that's going to rebalance for you. It's going to do what it has to. It's diversified. And then, if you want to get into some more satellite positions around the edges, it kind of mitigates the risk of you kind of stepping in any pointy
There we go.
objects.
So then if you're talking two, you get that portfolio, and then add something that's of interest to you, or something something that's, it's kind of the old like core and explore, or satellite positions like you mentioned. But that's a good way to think about it, I think. Okay, second question: are precious metals or Bitcoin ETFs worth adding to said core portfolio?
So generally, again, I'm biased, but I do like a little bit of Bitcoin in there. Obviously, from a risk return perspective, when we thought about the allocation to our all-in-one portfolios, the main lens that we were looking at, what percentage should we add to the portfolio was risk.
Yeah, drawdown risk more specifically.
Because if you do,
right?
you go to your finance textbook and you efficient frontier risk-adjusted return it,
Yeah.
it would tell you to do 100% Bitcoin, which is obviously not a reasonable.
Let's say most investors probably don't need
exactly. So what we were looking at is how can we maintain, if we're thinking about a 60-40 portfolio,
Yeah.
how can we maintain kind of the similar risk return characteristics or risk characteristics of a 60-40, and at what percentage can we add Bitcoin in there to maintain that similar risk profile while getting a little bit of ideally pickup from
Sure.
the Bitcoin returns in there. So that's how we ended up on that range. So we think that range is kind of a reasonable range to have in your portfolio.
Yeah.
Again, every investor is going to be different, but that's how we thought about it.
Sure.
Precious metals is precious metals. There's a place for that as well.
But it's kind of, I mean, sorry, not to cut you off, but just like, I think for both of those, the concept or the idea is to say, this is another layer of diversification, something that's got a bit of a less correlated return profile or return stream. Like, for example, I mean, and a lot of people have tried to compare gold and Bitcoin together, and I think it's kind of been debunked that they're not really equivalent types of assets, but both of them kind of achieve the same objective, which is not necessarily correlated to traditional asset classes like fixed income, equities, or at least they might in certain phases, like say a 2022 when there's kind of nowhere to hide. But for the most part, they do offer that added diversification to your traditional, and you mentioned 60-40, just for our audience, maybe that's less familiar with that term. That's a kind of a balanced portfolio of 60% equities, 40% fixed income securities. And then adding kind of both of these asset classes can be beneficial, to your point, on a risk adjusted basis, right? So
yeah, when you think about gold too, there's a couple different ways you can get the exposure. Like you can get it through, pure play like gold futures or spot gold ETFs, but also gold producers.
yeah,
If you look at gold producer stock prices, they're very correlated with the price of the metal. Ultimately, when you talk to the CEOs of these producing companies, like their expectation is you're buying a company because you want exposure to gold. Like if you take a look at these producers, they don't hedge their exposure to gold. Like you would think when you think about gold futures, you're like, oh, like
levered gold play.
These producers probably hedge their exposure when gold's high. They'll sell futures to lock in their price. They actually don't do that because their investors' expectation is if I'm buying, a gold company,
I want to be sensitive.
I want to be sensitive to gold.
Fair.
So that is also another way that you can work kind of gold in an indirect way into your portfolio.
Well, that does it for today. I hope you found that insightful. Each of those clips are from a full 30-minute video podcast available on YouTube, Spotify, Apple Podcasts, and more. Here at Fidelity Investments Canada, we're putting out fresh content daily, so please look up FidelityConnects or the recently launched Upside podcast for more. I'm sure there is a topic there for everyone. And you're here right now, so you know that the Upside starts as a streamed webcast, where you can learn to be a better investor and hear from some of Canada's best stock pickers and leading financial experts. To not miss a show, head to fidelity.ca and sign up for the Upside newsletter. Thanks for watching today, and I hope you'll join us again on the Upside. I'm Kyle Cheropita. Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.